The S&P 500 rose over 2% today after Fed Chairman Powell mentioned how close we are to the neutral Fed funds rate. The market took that as very dovish and rallied as a result. And so, was today a game changer? Are we now backing up the truck? So I'm going to break down today's move from a technical perspective, what we expect into the end of this week with trade news, potential news coming out over the weekend, and then into next week. Purely, again, from a technical perspective, with today's trade idea in an area that really led the way higher today, and you would expect to continue to lead on any bullish bounce. Let's go ahead and get started. Today is Wednesday, November the 28th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the market forecast on the S&P 500, and quite the day. We did get back up to this high point area, which is the previous near-term high point that's in between the bullish divergence. You see that bullish divergence we had down here with the lower lows here and the higher lows in the blue line. So the high point in between them, that's about where we got to. And we talked about that's a target. And there's going to be some near-term resistance in this area. The line's still red; it's not turning up, so it's still red, which means that we'll probably get some resistance in that near-term area. It's going to turn yellow tomorrow because we're above it, but we're in this near-term resistance area. Don't be surprised if we don't pull back down to around 2,700, maybe a smidgen below it, before we bounce and bring the near-term line down. Because remember, when the intermediate line is below 50 and rising, the near-term rallies don't last the customary 7 to 12 days. They generally only last about 3 to 5 days. Now, we are way up in the upper reversal zone. Very good sign in terms of the likelihood that we'll get an intermediate run starting, the typical 1 to 3 month run. That doesn't start until the green line crosses above 50. So there's a good chance that that's going to happen because of how high this near-term line is. Just don't expect it to happen right now. It can, but don't expect it to happen right now. You can see the market sentiment still down, and it's below 50, which means the next time we get an intermediate rally starting, we have a very good chance of getting multiple intermediate rallies. But don't be surprised if we don't get some near-term volatility. I said it before. I'll say it again. Don't get too wrapped up in the downward moves. Don't get too wrapped up in the upward moves because the VIX is still relatively high. The intermediate line is still below 50. So there's still going to be some volatility, some ups and downs while it's down here until we can get above 50 and cross it and hold it and stay above there. So that's what we're looking at right now. You can see from the Dow Jones Industrial Average, it's rising too. It's also back to that near-term divergence high point. Very similar. The near-term line is extremely high. Market sentiment's below 50. The NASDAQ Composite, same story. High near-term line, bullish posture but weak. Market sentiment below 50, and then finally and same peaking right now, at least today, above the moving average and at the divergent high point. And then of course the Russell, same thing, above the moving average at the divergent high point. These indexes, when things are bearish, these indexes are close to 100% correlation. When things are bullish, then different things will lead to the upside. That's why bullish trends tend to last so long, because different things will take their turn leading the way higher. But when things sell off, everything sells off, and everything gets bearish, and so they tend to and then they'll bounce all together too. Some to different degrees, of course. But you can see, that's what's happening right now. The market forecast. Now, the Russell 2000's near-term line is not as strongly bullish as the others because it's we had such a pullback here. But the patterns are all still exactly the same. We're at the divergent high points. We're a smidgen above the falling moving average. We have weak bullish postures. Market sentiment's oversold on the Russell 2000. That's why the near-term line's not as high. So market sentiment's below 50 in all of these. So they're all very bearish. They've all formed, those death crosses you'll see in a second. So they're all looking exactly the same and showing the exact same pattern. What does that tell us to expect going forward? That eventually we'll get a bullish posture. But it might not happen on this near-term run. Don't be surprised, going back to the S&P 500, if we don't get another near-term pullback. And when that happens, you'll see people saying, see, this is, bull trap. It's not a bull trap. It's just things don't go up every single day. As a lot of people don't seem to believe that, but things don't go up every single day. You'll get a near-term pullback again. Potentially, right? Of course, we can stay up higher because anything can happen. We've seen we've seen things go up, and usually when things happen, they tend to go a lot further than I expect, especially to the upside. So I wouldn't be surprised if it kept going up and up and up towards 2,800. But my expectations are we hit this near-term resistance, we pull back, form a higher near-term low point, and then rally from there. Now, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over the Market Scholars logo right there in the bottom right corner of your video, then click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me two things. Number one, you got something out of the video tonight. Number two, you want us to do it again tomorrow. Very simple way to give us feedback. You can do that right now while you're watching. Also down there, comment on anything that stood out to you tonight. What did you like? What questions did you have? Let us know. Join our daily Market Outlook email list with all the overbought and oversold clusters that we send out every day. There's a link popping out in the top right corner of your screen there. Follow me on Twitter for more content like this throughout the day. Join our Market Outlook community we created on Facebook. Also, a reminder, if you're watching this video on our blog, tell us, you can tell us, give us your feedback with 3 clicks here. Number one, click on this like button. That will bring up your tonight's Market Outlook tweet. You can click that like button there. 2, you can click on this Facebook image. That will take you to your Facebook, to tonight's Market Outlook Facebook post. You can like it from there as well. And then 3, click this like button. Those 3 clicks tell us really, really easily you want us to do this video again tomorrow. Remember too, you can comment on anything in today's video here among other market scholars in our forums with that link. To participate in that link, you can do in that forum, you can do it for free, but you have to subscribe to our site first right over here with this image. Just click on that. Alright, so let's go back to the charts, and you can see I mentioned that if to avoid a death cross, we'd pretty much have to completely reverse last week's move, which so far we have. So, now granted, we got 2 more days left this week, right? So we're not out of the woods yet, but you can see, again, when you get those 1 week drops below the 200-day moving average, if you don't reverse back up above it, then we tend to lead towards a death cross. But if you come right back up above it, like we've seen so many times, then that's bullish, right? You get a renewed divergence of the 50-day away from the 30-day. You have to get above the 50-day first, but you get a renewed divergence back up, and then not necessarily to another bullish high point, probably lower than this one, as you can see before, but it's a bullish sign. And again, the week's not over, right? You got 2 more days left to see what happens there. If you take a look, there's your Dow Jones Industrial Average, which is really close to, in fact, it did cross above the 50, just barely. You got the green arrow there. The NASDAQ Composite's not quite above the 200 yet, but when it does, it will get above both of them because they're sitting right on top of each other. The Russell 2000 also setting the low point with the death cross so far. We have to get above here to because you're going to make a return move. Usually after the death cross, you make the return move back to the 200. The question is, are we going to go back through it or hold it for resistance and start a bear market, right? That's the big question. And as of right now, with all the other charts, we would expect that we'd go through it and continue our trend higher. Looking at the 3 green arrows, we got almost 3 green arrows, almost on the stochastics down there. If I take a look at the 2-line versions of these, we got above the 30-day moving average. The 8 days not above the 17 yet. So in 1 day we crossed above the 8, 17, and 30-day moving averages. The next stage would be for the 8 to cross the 17 and both to cross the 30. Right? You can see the bullish divergence that we have here on the MACD. The MACD is above its moving average. The stochastics is not above 25 yet, but it is above its moving average. So kind of weak bullish signals here. Usually when you get those, until you get that convergence of these 2 lines back above the 30, don't be surprised if we don't get a pullback at least tomorrow, if not tomorrow and Friday. When you look at today's move here, you can see much higher high, higher low point. In fact, the low point is above yesterday's high point too. So we gapped up higher. We filled in the gap down to yesterday's high, which is right at the end of the day. We got up through the initial surge after Powell's remarks got us to the 4-week midpoint. There's the Hakinyashi Open. 272.40 right here is the 200-day moving average, roughly, on the SPY at the time. So you can see we've kind of gone through all those lines, just a little bit at the close today. But you can see there's some highs in this area. Again, don't be surprised if we don't pull back from a Fibonacci standpoint down into probably down into this 270 and above area, if we don't find some resistance, or maybe even down to 268.5 on any short-term pullback. If we look at the volume today, as you saw previously, it was relatively high, close, 127 million. The range today was 6.25 points. Now keep in mind, there's a little bit of a gap. So the low is at 268.33. We closed at 268.40. Actually, no, we didn't get we filled in the gap. So 6.25 points. That's our range with 127 million shares trading hands. 6.25 points is obviously off the chart, and that's and more than double the price, or more than 2%. The volume at 127 million is up here, so above the line too. So there's kind of your big move to kind of, a lot of people have been looking for the big move to solidify this bounce. There's your big move. Don't expect very many more of these, right? When we're bullish, the ATRs get below the average, the volume stays below the average, and this gets back below 1%, which means we get back down to ATRs below 2.7 points. That's down in here, right? So don't be surprised if we start tapering off again with smaller pullbacks. So, even smaller moves to the downside and the upside. So now if we get a big pullback tomorrow, then we're going to get some volatility in the short term. But if we get a couple little pullbacks tomorrow, maybe Friday, like I said, down to this 270 area with small ranges and small volume, that would be very typical of bullish bounces. All right, and finally, let's look at the volatility. You can see it continues to taper lower. Didn't drop down significantly with how bullish we were today. If you look at the ratio, we're still in that 95% zone. So that's why I say we're still not out of the woods to the upside yet either. We're still in this kind of bearish territory for volatility, excuse me. So don't be surprised if we don't bounce back up towards 1 a little bit, which means we bounce back up potentially towards 20. Not necessarily through it, but maybe into this 19 to 20 area. And then, producing a new near-term low point, higher near-term low point, and then we reverse, right? Then we reverse back and continue with the bullish move on stocks to the upside. All right, so to summarize, the posture is weakly bullish. This bullish near-term divergence is played out for the second consecutive time with a move up to the divergent high point. As before, our expectations now are for some short-term weakness. Last time, the short-term weakness got us back down to a lower near-term low point. This time, we don't expect that because we're coming up off of significant support. We are strongly oversold on the linear regression. And so you expect a pullback probably in that 270 area to a higher near-term low, then a bounce and kicking off the beginnings of a new intermediate run. Once that intermediate line gets above 50 for the typical 1 to 3 month period, probably closer to 2 to 3 months because of how low market sentiment is. Market sentiment being as low as it is sets us up for the potential for a 6 to 9 month rally as it gets above 50. And with multiple intermediate rallies to fuel that long-term run. So, what do you think? Do you agree with that outlook? Do you disagree with it? And again, all of that still with some expected weakness here in the next day or two. How big that weakness is will dictate how likely we are to get that bullish move going forward. So, do you agree with that? Disagree with that? Click that link popping out in the top right corner of your screen. Then hit the poll, either agree or disagree. If you hit disagree, scroll to the bottom in the comment section and comment on anything that you see that suggests otherwise from what we just talked about that you are willing at least to share with our Market Scholars community. Now let's talk about what's driving the price action today. And of course, the biggest news today that really drove the markets were Powell's testimony, or Powell's comments today about where we are relative to the neutral rate. We're quote unquote just below that neutral rate. So what happens? You have growth stocks and small cap stocks lead the way higher. Emerging markets, mid cap stocks, even value stocks lagged behind growth, but still by about half. But still did pretty darn well. You can see commodities doing okay, real estate, dividend stocks doing well today. High yield bonds, which have been under some pressure, doing well. The dollar was down, and long-term bonds are down as well. Gold taken off with the gains in the dollar. And of course, crude oil is the one risk asset that did not take off. In fact, it continues down. Here's our 2-week period. You can see things are rallying off their lows in emerging markets the most in the last couple of weeks. But if you just look at just today here we go. And go to 10 minutes on this time frame, then you can see the biggest gainers here: emerging markets, small caps, S&P, all doing really well today, about 2.25 to 2.5%. Starting off with some gains initially, and then you can see agricultural prices. There's developed markets. There's high yield. Gold is up. There's bonds and $1 and crude oil. Crude oil started the day strong. In fact, it rallied too, but by the end of the day, it really fell off. So it pulled back when things were kind of moderating, and then boom, at the end of the day, really falling off a cliff. And of course, again, that's you typically get a commodity price high when after the stock market peaks. And right now, here's your commodity prices, and we're talking like months after, like 5-6 months after, 4 to 5-6 months, somewhere in there. And here they were kind of together, and stocks are bouncing here, and crude oil's not. So not your typical commodity price peak. So we have a pullback. We've really fallen off about $25 here. I don't think though that this is the end of the commodity run. I still think that there's a good opportunity with another cluster here this week so far. There's an opportunity for us to get a decent move to the upside. You can see the price, the drop there, and then of course what we've got going on so far this week. Remember, we still got 2 more days left this week, but 2 consecutive oversold clusters. Again, we haven't had that in a while. I mean, we had these clusters here, and of course your death cross here. Let's go to we'll go to that in a second. They had those clusters there, but remember the dollar. The dollar was really taken off here. If you see today's move in the dollar, not so much taken off, right? It has a decent move, but today it fell back. So we started that run right there. Let's go back to the death cross now. I think like the Russell 2000, we've got the death cross here, and we're setting the low point right now for crude oil. We're setting the low point here and giving us an opportunity for a renewed run in these in this, which will have its impact on stocks too. If stocks rally, you'd expect crude oil to rally with it, and you expect the dollar to pull back, which is typical, especially after the Fed. If the Fed is close to ending its run, it's typical for the dollar to pull back there. If you take a look at the economic calendar, of course, that was your biggest news today. We did have a few other things. Inventories were out. New home sales were out. You can see they were down to continue to fall down. Real estate market's been really pulling back. Your trade figures are out. You can see this would be the month over month here. The exports are down. Imports are down as well. Then if you take a look at the GDP revision, GDP was actually kept right about where it's at, with the biggest chunk continuing to be the inventory growth. That's really led that higher, and we'll get a new estimate for the next quarter, Q4, tomorrow. So that was your economic calendar, but of course everybody was more focused on this. You can see from an economic standpoint, we're still basically hitting the estimates roughly, a little bit below, so it's a little bit negative, and not nearly as negative as it is globally right now. But the biggest news was what's happening here, and in March, you can see the odds for a rate hike in March. You get one in December, okay, that makes sense. But for March here, we're dropping back down below 40%. Considering that that's the next rate hike after December, you'd expect that number to be closer to 60%, hovering around there. If the market was expecting, the market's not expecting it. There's a chance, that's why it's at 40, but it's not expecting it. And if you look at June, so here is December. This would be the second one in March or June. This would be a third one. You can see this one's usually right around 40, or 20 to 40-ish, and it's nowhere close. So the market's starting to price in this idea that the Fed may be closer to being done with their rate hike cycle. And if they are done, like I said last time, the Fed stopped raising rates in June of 2006. The market peaked in October 2007. Remember, the yield curve inverted in 2005. So at the end of 2005. So that the yield curve hasn't inverted. It came close, but hasn't inverted yet. But we are pretty darn close to having that flat curve, which is ideally where they would like to hold off on raising rates anymore once you get to that flattened curve. So now when you look at the sectors and how they performed, you can see technology discretionary, your biggest winners. Communication services lagging behind a little bit. Industrials and healthcare doing okay too. Energy materials still not, we don't have that move higher in crude oil yet, so they're still lagging behind. The dollar hasn't really started to drop, and when it does, you'll see these two take the place of technology and discretionary. You'll see energy materials take the place of technology and discretionary up here above the S&P 500. There's your safe haven area, staples, real estate, utilities, these interest rate sensitive areas. When bonds rally like they did today, when bond yields start to head down, then these actually tend to do. When bond yields rise like they did today, these tend to underperform, and that's what happened here. Staples, utilities, and real estate both underperforming. Utilities actually down a little bit today. Was up initially after Jerome Powell's remarks were initially released. Then you had the Q&A in the afternoon, and it pretty much lagged the rest of the day, while everything else kind of made a renewed push up to some pretty strong high points. All right, one stock that's made a nice little run back up to the upper half of its, really close to its 4-week high, is Adobe. Good breakout move today. In fact, a fake out move. So you see how we broke down here right after November expiration in one day, and then then at the open the next morning, really dropping sharply, and then rallying the rest of the time since, and then getting back through those highs. So it's almost as if that breakdown here on the 19th never occurred. Right, when we had the big drops on the week of Thanksgiving, early Thanksgiving week, and then of course the big drop on Tuesday morning with the big volume. So kind of a fake out there, which tends to be pretty darn bullish. When you look at like the Bollinger Bands for Adobe, you can see back in the upper half of the Bollinger Band, breaking up through. There's going to be some, I don't want to be too aggressively bullish here because there's some overhead resistance, as there always is when you're trying to reverse a trend. There's going to be a lot of resistance to the upside, but a good sign there to get back in above that exponential moving average in the middle of the Bollinger Band. You can see the positive line crossing above 25. The negative line hasn't necessarily dropped yet, so it's still some volatility here, but doesn't mean that we can't look for an opportunity. Look at the market forecast here and the long-term chart. You can see the market forecast. Whoops. Let's get the actual market Adobe up. You can see its intermediate lines really close to 50. Good, strong short-term sentiment that we haven't had in a while. Back above the moving average from a 3 green arrow standpoint. You look at Adobe here. You got 3 green arrows with a spike in volume today. Again, kind of fake out move below, a fake out break of 240 to the downside that we're now back up above. And then finally looking at the long-term chart here, again, as you can see back, we dropped below 200-day moving average, got right back above it this week, and now back above the 50, closing as of right now, 2 more days left, but as of right now, above the high of the low week and above the prior week's high point before that. So, of course, we can look at selling that 240 with 20 days left here. We can look at selling that 240 put, because that's where the fake out, that's where the support was before the fake out to the breakdown to the downside. So we can sell that 240, buy the 237.5 for protection. You have to work your credits a little bit higher because the price, it's expensive stock. So you say, okay, if I get 63 cents, I get a pretty decent probability. That break-even point is right there at 240. Right, so as long as we hold it after this fake out, we're fine. And if it keeps going higher, again, like I've said before, if it keeps going higher, then you can see here, break even. There we go. We're at 249 today. A little bit below it here in the after hours. Then if it keeps going higher, you can see we're trying to get $63 per spread. If we were to get around that $31.50, that's where it has to get to, 264.60 today at least, to get 50, half of, you can see how it's a lot quicker to get that half, the first half, than the second half. So we can get that first half by getting back up into this 264.60 area, right into this area. So right up back to these highs, then we'll take it, right? We'll take it. And if it stays above, as long as it stays above 240, eventually you can see as time passes, that line, I'll get to my As another week goes on, we get closer to December expiration. To get that $31 now, all I need is to get to 257. So that line, that number of where I needed to get to, continues to move in this direction. Over here now, 253, which is just a little bit above where we're at, as time passes. So if we don't go up, it's no big deal as long as we stay above 240. If we were to fall below 240, then that's when we want to try to take a $63 loss as much as we can, and that's a few bucks away, a few bucks below that 240 level. So it'd be down into this 238. So you have to start filling in the gap that we formed at today's open. All right, that wraps us up for today. Now it's your turn. I want to hear from you. What are you thinking about the markets right now? What do you think about our market outlook, the trade idea? Click that link that popped up there in the top right corner of your screen. That will take you to our forums. Remember, you have to subscribe to do that. You can do that for free. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below and comment on anything that stands out to you. Join our daily Market Outlook email list. Follow me on Twitter and join our community on Facebook. Thanks again. Have a great rest of your evening, everybody, and we'll see you all tomorrow.